Manjunath Emalur to escort him onto the dais and welcome him with a floral bouquet. A brief about Giridharan R. Giridharan is a qualified chartered accountant having 12 years of extensive experience in audit, assurance, and consulting services. Giridharan is currently a director with GT, focusing on financial reporting advisory services. He has previously been associated with KPMG and Deloitte. He has managed complex projects including gap conversion, financial review, and financial reporting under US GAAP, IFRS, and Ind AS. He has also worked extensively on many financial reporting transformation projects and has a rich experience in managing these projects on many cross-border clients. He has worked across sectors including manufacturing, IT, healthcare, real estate, and financial services. He is a regular speaker at ICAI and Institute of Internal Auditors and Office of the Comptroller and Auditor General of India. With this brief introduction, I welcome you, sir. Over to you.
Hello, am I audible? Yeah, audible now? Yeah, cool. So, respected chairman, vice chairman, secretary, and members of Bangalore branch of SARC of ICI, thank you so much for firstly organizing a session on Ind AS implementation for NBFCs, very niche topic, and secondly for having me here to be a participant and a speaker. I will have my presentation rather brief, but I can pause in and then take questions as and when required, because some of these topics would have been covered by the previous speakers at different lengths. But I would also want to touch upon a couple of things. I have been requested to speak on implementation challenges on Ind AS, especially focusing on NBFCs. I would want to do a top-down here to look at the kind of challenges that any company that is moving into Ind AS will face, more focusedly NBFCs included and banks, and then probably take upon and touch upon topics that are more crucial for NBFCs when they first time adopt, as well as on a continuous basis when they start reporting periodic financial statements, be it listed or unlisted. So that's the way I would want to structure my presentation. At last, I've also included a section on the current financial reporting framework for NBFCs, which includes not just adoption of Ind AS, but other regulators' requirement like RBI, SEBI, etc. So with that prelude, I will just, is it possible to get this chair out so that the last thing is also visible? Okay. I don't know how much the other speakers have made the topics seemingly easier in terms of application of Ind AS. I am here to tell you that there are complex areas that we need to be looking at, or we have looked at in the past as part of implementing Ind AS on NBFCs. These necessarily stem from new concepts that we as auditors or consultants or clients were not exposed to as part of the previous gap, including RBI mandated requirements in the past. This include concepts like fair value, concepts like impairment, which are seemingly complex to understand and more importantly complex to implement, because as Venkatramani sir was referring to, there is no one right way of doing it. It is not possible to benchmark you in verbatim to another company to come up with and then say, hey, I have done better than you or I have not done better than you. Because there is nothing called that you can benchmark. There are broad parameters available that we can look upon on industry to look at broad set of parameters, key performance indicators, matrices, etc., etc. But there is no one right way or wrong way to do things. And this gives a lot of subjectivity that can either be used to the advantage of fair financial reporting or can possibly be misused. I think this is also one of the reasons why we also have additional regulations in place, especially from RBI, especially from SEBI, etc., to make sure that at some point in time, at least a minimum set of requirements are met over and above the principle-based accounting that IFRS or IND AS brings into play. Now, with these concepts, what we have seen is, however simple that you would want to have, whether you want to look at a portfolio of hundreds of loans or thousands of loans or lakhs of loans, some amount of automation, some amount of technology is expected. I mean, I would, at this stage, I would even call running a proper macro that is thoroughly audited, validated to be a technology or tool, just for limited purposes of this conversation, to more sophisticated models that involve use of AI or any other kind of technology. Now, when we use technology platform, a lot of other considerations are required, not just the data inputs, which I will definitely come to later, but using the right technology, the scalability of the technology, a lot of other consideration goes into play in terms of using. For example, some may say at this point in time that an Excel macro or Excel spreadsheet is good enough for you to come up with your model on ECL. Or for example, you're accounting for leases and then getting out with the lease accounting entries. But trust me, one has to look at the scalability perspective as well before we launch into, because the first time is when people are really interested, people want to understand, and a lot of perspectives are derived only when it is done for the first time. So a factor or a tinge of thought is expected to be also be made on the scalability of the technology, so that whatever business aspirations are there can also be met with the technological aspect of it, rather than reinventing the whole wheel over and over again. Third important aspect I would see is upskilling the team, often an overlooked concept. And the reason I'm saying this, because as a consultant, I have helped a lot of NBFCs implement or go through this process. For all practical reasons, what I generally see as a trend is the companies or the CFOs or even the finance controllers look at this to be a one-time exercise. They say, engage a consultant, get the IND AS converted, and then we are there. Now, unfortunately, though it's a very advantageous position for me as a consultant to go through this process and then get all the work for myself or for other consultants, trust me, we need people who can challenge us, because the data is actually of the company. No one other than the company's own management or the employees can better explain their own data rather than the consultants. So with that factor in mind, upskilling the team becomes essential for them to understand. Typically, if you see IND AS implementations, normally 1 or 2 training sessions are given to the employees. Trust me, it's not enough. So, especially complex data models, when we have multiple models that are being developed, one model for lease, one model for EIR, one model for ECL, it is important for a person to understand what goes inside, why it went inside, what are all things that will change in the future, and what will remain constant, what will change. That level of detailed understanding is required for the management to be able to have a sustained financial reporting team. And for this reason, I think upskilling is very important. How do we upskill? Train, put them on the job. That's the only thing. They'll have to consistently read until they get hands on some of these principles, concepts. Not all standards are required, at least IND AS 109, IND AS 32, IND AS 107, 113. These are all standards that are going to have pervasive impact on virtually almost all NBFCs. So it is important at least these standards are thoroughly nailed, looked at more closely in terms of their own business models, and see how much they can understand their own data better, so as to not just challenge, but for example, on an ongoing basis, they want to look at a different consultant or have a different technology in place. Only understanding the data will be able to, and understanding the data and the concepts will help them evolve. Changes to key performance matrices. I think a lot of times what happens is we are so focused on the models, we are so focused on the tools, technologies. What we tend to miss out is finally what is getting reported in the financial statements. At times it becomes too late for us to see that there are irreversible implications on some of the key ratios. I've seen cases, in a couple of cases, where we had to go back and then roll back the entire model because the capital adequacy ratio was not met. We did all the model. We were so focused on the model, on the implementation. Finally, we figured out that the existence of the NBFC itself was a question. So, so it is possible that we tend to overlook softer aspects, and hence it becomes important to go back to the drawing board every now and then, especially during the implementation phase. Data-related challenges, I think we implemented 2019 IND AS for unlisted NBFCs. I think the roadmap was from 2020, 2021. We have about 3-4 years or even 5 years of data that is available from listed entities, financial statements, the models, etc. What we really don't have is the quality of the data and the spirit with which some of those disclosures have been asked for. We tend to see, I mean, sorry for this, but a lot of disclosures are being boilerplate, copy-pasted from others because they've given some disclosures, or it is mandated by some of the regulators, not qualitatively disclosing what is expected to be disclosed at any given point in time. And one of the reasons that I see is because, one, we want to comply with the regulation. Second, we don't have adequate data to go back and then do. Especially when we had periods like COVID, which nobody could forecast, nobody could predict, or nobody could do anything with that data patterns, becomes very difficult. While we are saying that we have 5 years data or 4 years data, essentially what we're speaking is about 1 or 2 years of actual data, which is not affected by any of the pandemic or any of the exigent activities that may skew up the data or down when we start putting that into models or matrices. So that's a continuing challenge that we need to live with. But most importantly, what we have seen is people look at the data more from the current year requirements. They don't know that even comparatives are required. And in terms of developing some of those models, even if it is Excel based, we need to go back 2-3 years back in time. And then the same amount of quality that we have for the current year, once we go through the implementation process, is also required in the past. So getting to that data is a challenge. Now, last and finally, the regulators' expectations. Given that there are multitude layers of regulations, RBI keeps coming up with new circulars every now and then. We have changes to the standards, not just IND AS 109 implemented, we have IFRICs, we have agenda committee decisions which clarify some of the positions that have been given in the past. A lot of changes happen in the regulatory reporting framework. So one expectation is to follow all that in spirit. Second, it also poses the reason some of these changes are happening is because the regulator wants to have a tighter scrutiny on some of these aspects. So it is important that some of these numbers that we end up presenting are going to be scrutinized. Even if it is not being scrutinized by the regulator, what we have seen as part of the practical experiences, all these falls flat when it is picked up for a due diligence or when it is being picked up as a target for acquisition. When we become the target, if the models are not speaking for the data, or if we don't know how sensitive our model is to some of the changes that the acquirer is planning to adopt, I've seen deals falling just through on account of models not being sustained, models not being sustainable, because the acquirer doesn't have a picture of how much they need to be absorbing as part of the target once they take over. So the deal just falls through. So I mean, I don't see IND AS as an implementation based task, we just need to have a 360 holistic view in terms of what is happening to be able to appreciate subtle nuances of Ind AS, especially on NBFCs. With that, I'll start moving into the specific aspects. While I have covered on the general aspects, one thing which the other previous speakers might also have spoken is the impact of 4 standards, if I can put it. Ind AS 109, financial instruments, Ind AS 32 on presentation, Ind AS 107 on disclosures, and Ind AS 113 on fair value measurement. I think these 4 standards, in my view, have the most impact on NBFCs and banks, and these are all the standards that the implementation partners also focus a lot. Of course, there are standards like leases, you have income taxes, which have a whole different story to speak about. But I think from an implementation effort or sustenance effort, I think about 60–70% of the effort goes into managing and concluding these 4 standards. So these 4 standards, you may know that have a host list of requirements starting from initial recognition till presentation disclosures, cover a whole list of gamuts, and more critically important because these also from a financial statement perspective have the highest amount of key judgments and estimates, which any auditor, both from a key audit matter perspective or from a regulator for assessing, for example, NFRA picks up this file for scrutiny. What are they actually looking at is probably these key judgments and areas where they want to look at how far the controls have been set up, how managements have looked at some of these key judgments estimates, how far consistently they have adopted, and how they fare up to the industry standards. So these judgments include business model assessment, fair value measurement, impairment losses, EIR. All these 4 concepts should have been covered in sufficient detail is my understanding, but feel free to just pause and stop in case if you have any of these matters to be covered. By looking at some, I think I would have looked at about 40–45 NBFC financial statements to come up with the key audit matters. I think the key audit matters primarily involve for first-time adopters, adoption of Ind AS as the first-time 101 exemptions choices taken itself has been put as a key audit matter. Information technology systems and controls on some of these models that have been placed, especially again on the first time, has been considered as key audit matters. Measurement of VCL, valuation of financial asset, especially fair valuation, disclosure on fair value hierarchy, level 1, level 2, level 3, transfers in and out, etc. have also been classified as a key audit matter. Income tax related matters have also been assessed as key audit matters. So why I'm putting this here is because I'm also planning to tell you what auditors look at from an Ind AS perspective and what finally transpires into financial statements. So if somebody is reporting them as financial statements, there is significant judgment and estimate involved, and hence this becomes the focus area for any regulator who wants to pick up the file. So that's. So I will now move on to the specifics again on these 4 standards. I think Venkat sir should have covered on segmentation of loans. So I'll try and keep it very, very brief. The objective of the loan portfolio is to have a unit of measurement or unit of account, to start putting in the perspective of the model requirements or whatever is required to be performed from an ECL model or an impairment model perspective is determined or tagged at a unit of account level, and that unit of account is called as a segmented portfolio of asset. So you might have broad portfolios like corporate loans, retail loans, basically breaking down of the entire loan book into subsets that have similar characteristics. Now, the most important aspect here that I want to touch upon is not to have too large a size of a portfolio, not have too small of a portfolio. And what I mean by that is, we tend to become very data focused once we start having so much of information, or we don't know how to consume it or how to rationally consume it in such a way that there is a balance between the model itself and the overall perspective of what we're trying to do. I'll give you an example. For example, I am putting in 15 parameters on a model to come up with an output A. Had I put in only 5 parameters that are very basic but are essential, I might have completely come out with a different estimate called as estimate B. And these numbers, trust me, are significantly different from each other. And what is important is not going too far where you are not able to come back and then redo some of these aspects. To have a balanced state of mind every time you get into a major phase. Say, for example, you have determined what technology you want to use. You have deployed it, you are implementing it, you are sustaining it. At every stage of this, assuming these are all the 4 phases in which we normally look at a model development for both conception as well as execution, I would see that at least 4 times we look at the model in terms of output to be able to backtest and then come back and then say whether am I heading towards the right direction in terms of having a balance between quality of data, the segmentation portfolio that I have, and the reporting requirements that are there. So the other aspects that I would want to touch on, I mean, again, more focused from a first-time adopter, because they have been so accustomed to prudential norms or other regulations of RBI, a lot of data has already been tinkered to suit that kind of reporting. Now going back to basics and then having the raw data to construct any kind of a model becomes very difficult. So the suggested approach for NBFCs looking out for IND AS implementation is start early. Look at what other people have done. Don't wait for the implementation exercise to happen and not being able to cope up with the pace at which information would be expected at that stage. So with that, I will move on to asset classification and provisioning. We normally call this as staging. The standard expects you to, taking a pause here, I would want to take, sir, I think I will get you the slides passed on, sir. I'll make a PDF of it. I'll make sure that the slides reach out to all of you. And I'll also give you my Connect ID at the end of the session so that you can reach out to me if you have any questions. So all these requirements again are from IND AS 109 perspective or 107 perspective from a disclosure perspective. We'll also try and top this up with RBI and other regulations that are in place for NBFCs at a later stage. But the objective is we are covering first the principle-based accounting, and then we are topping up with rule-based accounting, which is RBI's norms. RBI's norms, nobody knows whether there is a rationale to it or what data models they have put in to come up with the provisioning norms, classification of assets into standard, substandard, all that stuff. I'm not getting into all that. What we're trying to look at is from a challenge perspective, what we need, the biggest challenge will not come from RBI. Because RBI is rule-based, okay? If my asset portfolio crosses a particular bucket, I need to provide X, matter finished. So that's an easier bit to handle. What is more difficult to handle is the principle-based approach, and that's the reason why this is being put front, and that is being topped up as a top-up layer, so that we understand how our data models work, and then be able to better gauge on why there is a difference between what is expected out of RBI's norms versus what my model is giving out at any given point in time. So with that prelude, let me go back to staging as a concept. We have 3 stages that have been defined under 109. We have stage 1, typically inception till the portfolio reaches stage 2. We have stage 2 itself where the asset is classified as underperforming, or where we normally call that there is a SICR or significant increase in credit risk. We also have stage 3 where it has become credit impaired or it has become non-performing. Now, what is more important here is, I think, again, Venkatramani sir should have covered a lot of ground in terms of what is 12-month ECL, what is lifetime ECL, all that stuff. As a concept, I'm not getting into it. What I'm trying to get into as an aspect is these, as a principle, are applicable not just for the loan portfolio alone. It is expected to be applied for debtors, investments, loan commitments, financial guarantee contracts, lease receivables. Look at the asset side of the balance sheet. Virtually all financial assets will go through ECL as a model. In some cases, you have been given a choice to either adopt a 12-month model or a lifetime model, but that's it. The model or the framework that is given is still the same, by and large. So that is required. The reason I'm trying to highlight this particular aspect is because we don't have to stop necessarily with our loan book. from an ECL model perspective. It has to be, again, looked at from a financial statement perspectives. What are all my, so the way we normally start is to look at what are all the financial assets, what are all the financial liabilities, whether ECL model will go through or the model is expected to be there, whether 12 months, lifetime, credit impaired, all that is later. Whether this will go through the ECL model or not is the first aspect to look at. And I'm telling all this because this takes a lot of time. There is an expectation that we know our own data in depth, to know what are the kind of assets we carry in the balance sheet, what are all the nature of financial assets, and what are all the assets that will go through the model as such. So again, the 30-day past due, DPD, these are all concepts that I'm not getting into. So I want to take a slight detour here from what Venkatramani was saying. He didn't want us to go into any of these concepts like PD, LGD, EAD, all that stuff. He wanted to keep it as cash shortfalls. That's it. Present value of all cash shortfalls is expected credit loss. But mind you, he also said this is what virtually it will result in. While these are all concepts that have not been defined under IND AS 109 in so much of detail, these are all essentially methods that are coming out based on the application guidance available, CECL model that have been developed by other gaps, etc., etc. So he wanted to probably, I think, simplify or oversimplify the concept of ECL in short. So he used the word cash shortfalls. But when you start engaging with consultants, probably these are all the questions that they'll start asking. Because these are all the areas that people normally bucket, or the companies are expected to bucket themselves, focus on themselves, because each of them are separate oceans in itself in terms of coming up with a model or data or whatever it is. Again, this is irrespective of the fact whether we are using a simple Excel spreadsheet with some macros to run the program, or we are using complicated data models that are embedded with AI or any other new gen technologies that are there. I mean, we are talking principles here. We're not talking technology or sophistications. Now, what I want to focus here rather is on, other than the historical data, the probabilities, and other matters that go into as key assumptions, the standard also requires use of macro models. And what I mean by macro models is futuristic scenarios, macroeconomic factors, geography-based assumptions, and things like that. So it is important to look at, say, for example, I have given a loan to a person who primarily trades with Chinese market. Now, what is the likelihood that China, on account of China not being performing, or Sri Lanka not being performing at its optimal level in the next 1 year or next 24 months or 36 months or whatever the loan tenure is, what is the likelihood that it will impact the loans that I carry? What is the expected default on account of it? So a lot of these generic questions need to be factored down into what is relevant for one's business, and that is the reason why we say that there is no one right way to do it. For a particular loan, it is highly customized to a particular loan book. So that's the reason a lot of time is required to spend introspect on one's own data, to be on top of these, to be able to fairly predict on which data model is right whenever somebody suggests it. And normally the issues on ECL come up on 4 aspects. Key policies. What I mean by that is, where do we start? We started off with segmentation. We'll put a definition for default. Unfortunately, standard does not define what is meant by default. I think you would have heard this in the past. So we'll have to come up with definitions. We'll have to come up with policies. We also need to define what is meant by significant increase in credit risk. What is low credit risk exemption if we want to take it? What is the period over which we are assessing the exposure? What are all the discount rates used, collaterals? I mean, we have not even started building up anything. We are on the table discussing that, hey, I'm looking at either implementing a new model or trying to change an existing model to get into a new, better, sophisticated model. Whatever is the issue said and done, these are all the expected discussions that will happen on day one, when we immediately start thinking on. That key policies will be followed up by technology that we plan to use. Again, given the nature of and type of NBFCs, normally the way to look at it is to look at the NBFC itself and decide what is the appropriate technology rather than going and suggesting anything. It's like saying that SAP is the best tool available in the industry. No, it may not be. So look at what is more helpful for the client and then look at it. Then model requirements, where do we need to focus on? Whether it is going to be on PD, LD, EAD, while all of these require some amount of detail, either of these three or all of these three, depending on the loan book, have a different scale of depth that would be required, different level of assumptions that would be required. Hence, it is important to understand which of these aspects and what will be the inputs that will be governing the model. What will we do with prepayment? Do we have prepayment as an option? How significant it is? Do we want to do a simple approach, probability weighted average approach, scenario analysis, back testing? Again, a model is only as good as the data that we given, one. The consistency with which we given data, and what I mean by consistency is data without any vagaries. For example, if I include a COVID period over a non-COVID period, obviously the results are going to be bizarre. Now how do I sanitize the data? Should I take in the data or not? Will I take in the data, add a percentage of markup saying that these are all on account of normalizing the COVID related matters and then coming up with the data? Those critical aspects. Backtesting, comparing it with what was your expected output with what the model throws out. And then fixing up whatever inputs are there, and then being able to tweak some of those assumptions and then get a better version. So it's a reiterative model. Other than the internal data as we spoke, borrower-specific external data and broader external data depending on the geography, depending on the other macroeconomic factors that we want to consider. We have seen somewhere between 5 to even complex banks have considered 30, 40 macroeconomic factors itself as part of sophisticating some of these models. So, I mean, I don't want to generalize here. I would want to keep it general here. Again, I'll just touch upon important to have a policy written document telling you these are all things that we have faced as part of implementation partners when we are called for the second iteration. Somebody has already got things implemented. We are stepping in for a model development, a scalability assessment or test of the model from an acquirer's perspective using their models. We have not been able to see a written policy at all. They have a beautiful spreadsheet that comes out with a lot of inputs, all parameters are there. What are their policies? Hey, what is your default rate? I don't know. Not documented. Okay, I mean, carefully look at all that. I mean, these are all internal steps that can be taken, but goes a long way in terms of governing some of these aspects. On the model, as I've told you, a lot of external help is sought, if external help is sought in the first place. PD, LGD, EAD is the first one. Asset classification is basically relied on from whatever management's inputs are, but broadly tested. It's like an actuarial base data that is being given to the actuary. So the actuary will perform broad logics, but he will not go into and then start questioning or auditing the data. Staging is again going to be looking at based on the policy documented when there is significant increase in credit risk, when asset is moved from stage 1 to stage 2, stage 2 to stage 3. The reason is because from stage 1, I think stage 1 is going to be simple, right? If I get a 5% loss rate, it's going to be at a portfolio of 1 loss account, 100 rupees exposure, 5 rupees, 5% is the loss, 5 is the outcome. But if the percentages changes from 5 to 15 or 20 when it moves from stage 1 to stage 2, the exposure is going to be dramatically increased from one quarter to the other, assuming that the asset moves in between 2 quarters from stage 1 to stage 2, and that NBFC is required to report this matter as part of the financial statements. Significant risk will be there. So we spoke at length about forward-looking adjustments. I have put in some of the best practices that we normally see. What we also suggest and recommend is to build in the disclosures also as part of the model itself, rather than only coming up with the rates and the rate testing. And we also try and work with the FP&A team to see if we can forecast some of these as part of the next 12 months or next 15 months or whatever is the cycle, so that this can be baked into as part of FP&A, and then they can come up with the budgets with a more appropriate ECL number or as their model. Again, all best practices, nice to have. I've touched a lot of these aspects in the past, but just to quickly cover the aspects that I wanted to touch upon from this perspective is regularly look back on the model, regularly look back on the outcome in terms of whatever the output is. Typical period is 2 to 3 years when there is change in data. What I mean by that is not looking back based on the same data. That's only going to give you the same output, okay? What I mean by that is when new trends or patterns emerge, maybe a 1 year new additional data, a new business segment that has been made, a new portfolio of assets that are coming into play that we have not serviced in the past. Say for example, assuming I service Karnataka, Andhra, Kerala and Tamil Nadu as my primary market. Now suddenly I'm going into UP or Bihar as a state for expanding my services. Now, one, I may not have data. Assuming 1 year down the line, I have some data to predict my customer behavior or any other scenario-based assessment that I need to be doing. Right time for it to go back and then rebalance my model to see whether it is giving me the right picture or whether I'm able to anticipate the losses at the time. What we're trying to do is basically to see how early I'm able to realize and then foresee that a loss is coming to me. That's all ECL is. Now, if you ask me from experience on what is the best way to assess the outcome of the model, look at the actual losses. Look at the actual losses for 1 year. Go back to your model and then see how quickly this loss was predicted in that model. If that was predicted early enough, the model is reasonably good. If it was not predicted for whatever reason, it means that one or more parameters need to be tweaked in the model to get the right output. It is as simple as that. But again, we need to know when to go back, not too frequent, not too late. Whenever the right way to what we normally advise is to go back and then look at it every time you get into a new market. You have a different data that is available. Even otherwise, look at it once every 2 years. Revisit the model. Look at whether specific data, parameters, you need to even continue with the model. I remember Venkat sir saying that there is no one right way of doing it. You can switch models. But he was also mentioning that you need to be consistent. So it is not that every year I come up with a new parameter or a new model to come up with the requirements. Some requirements need to be, some are expected to be fundamentally basic to the industry, to the business, or to the entity that it operates. And you top up with some of these various parameters to look at what is. The other aspect to look at it is, what is the threshold that you would want to, okay. Assuming you have a model, you have a threshold variance of 2 to 3%. The moment it hits 3%, the moment it hits 2.5% is also a right time where we think we can go back and then relook at the model in terms of various parameters, whether model needs to be changed, etc. Significant increase in credit risk. The key questions that we currently now face is when we have a loan portfolio, the first question that people ask us is, should COVID period to be looked at a separate distinctive period, or should be factored into as part of the loss model? Normally we say that it is beyond anybody's conception. Nobody could have anticipated using the highest of models in place. So we normally take that out from all the assessments or analysis. But that is not the perspective with which regulators may see it. That is not the same perspective with which investor or analysts may see it. Now, I think this is being covered as part of the subsequent slide. We have started moving into through the life cycle to point in time, right? I mean, we are expected to gauge. I'll just show you what I mean. I've tried to graphically represent what is TTC and what is PIT. Now, as part of incurred loss model, when we were looking at the loan portfolios over time horizon of the loss, which was expected to even out in most probable scenarios. Over a 5-year period, over a 3-year period, whatever the loan tenure, this was expected to be averaged out. So you see a straight line here. Assume that loss rate is 5%. Okay, it's a straight line. Now this was on prudential norms. This was also under incurred loss model. Now what ECL expects you to do is also to consider PIT PD, which when I mean by that is, in computing or in determining probability of default, you are also expected to look at the point in time expected defaults. If you look at the point in time expected defaults, the curve is extremely high or low. Suddenly I start off with 5%, I suddenly end up 8%. These are all small time, short term changes on account of behavioral patterns, change in the economic scenarios, or change in the customer pattern, geographical pattern, new tax law imposed, whatever could be the reason. But the expectation is that this is what is being factored as, this is what is expected to be factored as part of ECL and not the straight line curve. Maybe at 3 years down the line, when you look at the portfolio, this is getting averaged out at 4.5% or 5%. But when you take a provision today, maybe on month 2 or period 2, whatever you want to call it as, you might have taken a provision at 8%, which would have gone reduced to about 2% in period 4. I mean, this probably, I think, visually explains what is the difference between an incurred loss and an expected credit loss. That was the objective here. The second, I mean, we have spoken, I think, at length on the ECL models. Now, I'll spend a little bit of time on EIR. Again, this is another area of pervasive impact, starting from revenue recognition on interest income or whatever it is, your borrowings, your loan assets, prepayment costs. A lot of these can be affected by the EIR computation. Normally, we have again seen entities developing a model to come up with the EIR computation. All the aspects that I explained you on ECL model is very much holding good for EIR as well as a concept. Again, I've spoken about input collection, processing of data, output. I've given some practical considerations and best practices of EIR development if you're planning to do it. Given that we've spoken a bit on EIR and ECL, the next aspect that we normally see NBFC struggling from an implementation perspective is the concept of fair valuation. Impairment is also a way to come up to fair value, but since we have covered impairment as a topic separately, we will be looking at all other fair values that the standard lays out. I've tried to summarize the normal diagram on IND AS 109 in terms of how do you classify financial assets and financial liabilities. Once you have the classification right, whether you know whether the asset is or the portfolio is held for hold to collect and sell, hold to sell, or whatever it is, the classification becomes extremely important is because this is where you decide whether your P&L will become volatile or not. As long as it is FVTPL, every asset is going through the P&L volatility is going to be high. As long as it is FVOCI, partly volatile, partly not volatile. What I mean by that is, if in future it is expected to be reclassed back into P&L, to that extent it becomes volatile. If finally it will remain under OCI and it will move into reserves directly from OCI without subsequent reclassification into P&L, to that extent it is non-volatile. Again, I don't want to get into the instruments. You have currency swaps, which will ideally go through FEPL. By default, you have derivatives, you have hedges, cash flow, fair value hedge, cash flow hedge, net investment hedge, whatever the models are. Typically, what I've tried to summarize here is, I've looked at the financial statements. Normally, mutual funds for NBFCs are FVTPL, rightfully so. Even if they are expected not to be traded in the near future, normally it is FVTPL because the objective is to hold and sell. So we look at investment in government securities, debt instruments. So what I've done is, these are all the general classification of assets carried under NBFC. I've tried to portray what NBFCs try and do, where do they classify, to give you a guidance in terms of where normally classification is done and why. Those are all the 4-5 normal types of assets that are found in the balance sheets of NBFCs. Please feel free to add on if you have anything specific that we can discuss here. I briefly touched upon this concept in the beginning. We spoke about fair value disclosures. Normally people will say it is 107, but ideally 107 only says that you go back to 113 and then pick up the disclosures and then come back. So because the fair value as a concept is defined back in 113. So you have your level 1, level 2, level 3 disclosures with directly observable input, similar observable instruments, and unobservable input. While this is slightly technical, all I can tell you is, mutual funds, typically you have an active, whatever is actively traded in the stock exchange will typically be classified as level 1. What is having a similar portfolio but is not actively traded will typically be classified into level 2. Completely, for example, if I want to fair value my furniture, fair value my fixed assets, I don't have a comparative market available. It's primarily based on management's own assumptions, whether using a DCF model or any other model. All those aspects are typically considered as level 3 and then are reported accordingly. What is observable, what is unobservable? Again, theory here, so I don't want to cover on it. If you have questions, I can take it up. Again, objective is detailed disclosures are asked for, so it is important to understand what are all the assets that will go through level 1, level 2, and level 3. More importantly, what will happen for transference and transfer outs. For example, an asset that was previous year classified as level 1 is moving into level 2. Or something that was classified as level 3 is now moving into level 2 or level 1. A subsidiary is, or a strategic investment is getting listed. A strategic investment, typically normally I've seen companies take the route of FVOCI, where they don't want the fluctuations to hit the P&L. So they normally take the irrevocable option of classifying it as FVOCI. Now assuming that this is retained at cost, and this would have been happily classified as level 3 investment because it is unlisted, they'll determine the fair value using management techniques and then they'll report. Now what happens if that subsidiary or this strategic investments goes for listing? So all those aspects, and how do we present movements between stage 3 to stage 2 or whatever the case is. This is not just for investments, it's for all financial assets. So we need to be really careful in terms of how much data we have and how do we track it. It's all happening during points in time during the reporting year. It's not all happening at the end of the year. So it is important to have some kind of a tracking mechanism to be able to report this accurately. Again, highest amount of these disclosures are applicable to NBFCs and banks. So 113 gives you host a list of, because again it is principle based, it wants fair disclosure, more disclosures. So in my view, the only thing I can probably say or see the best practices is to restrict it to what is required. So moving on other matters, again I touched upon this as part of my first slide when we said impacts to key ratios are generally overlooked. IND AS as an implementation concept is expected to have some or significant impact on some of the key ratios, irrespective of the extent of impact. Now, what is more important to understand from, again, I'll go back to ECL or EIR or for that matter leases if it's a lease intensive organization, to look at the outputs of the model at the conception stage or the development stage itself to see how much of some of these ratios are getting impacted and what is the ratio that I want to project. So are the models trying to go back and then tell us the right picture, or is it too late for us to go back and then redo with any of those ratios here? Again, depending on the NBFCs, we have several ratios that are being disclosed. Given the nature of balance sheets moving from historical cost to fair value, a lot of upfronting is expected to happen on unrealized gains, losses. A lot of assets that were not there in the balance sheet are expected to be pushed through balance sheet on account of implementing lease standards or whatever it is. So it is by large expected to have at least a good amount of impact on the ratios that were previously reported. So objective is to be wary of it. The other often critical but overlooked aspect is looking at taxes. Again, I mean, I'm talking about current as well as deferred. A lot of these IND AS adjustments, be it on account of 109 or any other standard, have a lot of timing differences in terms of recognition of gains or losses in the P&L. Given we are moving into again fair valuation as a concept, a lot of mismatch can happen between the timing at which the loss actually occurs, which is what is the time at which it is allowed for the tax books, versus what is happening in the financial statements when it is recognized upfront. Because we are anticipating a loss, we are recognizing upfront. Whereas the tax books will allow you only when the losses are actually incurred. So these are expected to have a significant difference between the taxable base and the accounting base. Hence, the timing difference is expected to be subsided only through an impact of deferred tax liability or an asset adjustment. A lot of deferred tax assets are expected to come up on account of significant enhancement in loss allowance and fair valuation losses, if it is going to be a loss. A lot of DTA adjustment is expected to be coming in the balance sheet. It is expected that they look at the proper classification of the deferred tax assets and liabilities and then account for it. So I've given broadly some 3-4 line items, but every item that has a timing difference will have a deferred tax impact. So that's the key here. I have restricted here myself, before we go on to this slide, I have restricted myself, as I told you, to maybe income taxes, the 4 standards on financial instruments that I spoke about. I think I've made a passing reference of leases here and there, but other than that, I have not touched upon much of the standards, because I believe that these are all probably involve bulk of the efforts in terms of IND AS implementation or managing for NBFCs. But if you have any specific questions on any other standards, we can pick this up. Now moving on to the financial reporting framework itself, NBFCs and banks, my view, are uniquely positioned whenever they are moving into a new gap, be it IND AS or anything else, because they just don't have a principle-based accounting framework which other companies have, which are non-NBFCs or non-banks. But they also have additional top-up layers through master circulars of RBI or RBI regulations or any other act that they may need to get into. While it's like this, the way I see it is like it's having IFRS and US GAAP going together parallelly. Why I'm saying this? Because US GAAP is normally perceived to be a rule-based accounting. IFRS is generally expected to be principle-based accounting. IND AS is normally expected to be principle-based accounting. RBI's guidelines are generally expected to be rule-based. It's going to be thread fast. So you have a coexistence of both. So happy marriage between these two regulations on a consistent basis is the most critical aspect that NBFCs need to look at, not just from a first-time implementation, but also from a regular reporting perspective. For the purpose of this slide, I presume that they are listed, so they have to implement IND AS. But NBFCs who are not expected to go through the IND AS cycle or who are not within the thresholds of the IND AS are expected to comply with the existing accounting standards. But mind you, it's only a matter of time before these concepts are percolated down to the last NBFC that is available. It's only a matter of time. One. Second, it's only a matter of time before you are being acquired by someone. If you have a strategy in place, a business model in place, people are always looking out to buy out. And the first thing that comes up on all these discussions is what is the gap that you report on. The moment the NBFC says that it is Indian gap, several eyebrows are being raised by the potential acquirers because they are completely used to seeing a different set of numbers what the target is showing up. So they don't know. The levels of confidence are immediately brought down. That's the way normally the industry sees. And so it is important to be mindful of the investor sentiment, the analyst sentiment in terms of some of these aspects. Now what I've tried as part of this particular section is to give you a list of current applicable RBI provisions or disclosures through master circulars, which are over and above what is there under Ind AS, which only gives more detailed, layered accounting. Not just that, we'll also have to make sure that we do a consistent reporting between what is being disclosed under Ind AS versus what is being disclosed under RBI regulation. For example, we cannot have apparent conflicts between what is reported for the purposes of statutory disclosures versus what is being principally reported under Ind AS. For example, I am saying that an asset is good under Ind AS. For the purpose of RBI, I cannot say that it is a substandard or a loss asset, but for whatever reason. If I'm ending up saying that, then I'll have to have a basis or I'll have to have an explanatory note to explain why there is a significant change in the classification between Ind AS and the regulation. More importantly, it's also a time probably in my view to go back to some of our principle-based stuff to look back and then see whether we are doing the right thing. So the master circulations have specific disclosures for COVIDs, for comparison between prudential norms versus what is loss models under ECL. How do we present the differences? I think there is impairment reserve that you will move into if the provision under prudential norms are higher than ECL. Again, that's a triggering point to go back and then see what our model tells about and what is the story that we're talking about. But any which way, there is a guidance available. And we also have got scale-based regulations where additional disclosures are expected to be done. What I wanted to simply say is that on top of your own normal complexities of Ind AS, we also have to marry the requirements of RBI. On top of it, this needs to be done on a quarterly basis or on a half-yearly basis, as the case may be, topping it up with SEBI regulations when they go for listing, or if the entities are already listed. So it is important for us to have all these factors into account when we prepare or look at financial statements of NBFCs. And even for practitioners who are looking at NBFCs for the first time, these are all the aspects that we need to be looking at, whether they are disclosing all these aspects over and above what is expected under Ind AS, whether those disclosures are apparently not conflicting each other, and whether the story that a company is trying to say or entity is trying to say is actually resounding through the disclosures or the accounting impacts that they say. That's ultimately the objective of reporting financial statements. So with that, I take a pause and then hand it over to you if you have any questions, any aspects. I think I've tried to cover most of the challenges that are being looked at by NBFCs from my own experience, from experience of the firm, and some of the best practices that we have seen as part of implementation. Any questions? I can take it up or give it back to you. Okay, so if there are no questions, I'll wrap up my session. I'll give my contact details. I forgot to put that here. I don't want to do it now. I'll probably give my card to the people here. Maybe you can reach out to them and then reach out to me if you have any questions. Happy to help. Thank you so much.
Thank you, C.A. Giridharan, for that wonderful speech and deliberating on the implementation of INDs. On behalf of the Bangalore branch of SIRC, I request C.A. Manjunath Mallur, Vice Chairman, to give a memento to Muralidharan sir. Thank you, members, for spending such wonderful time, and thank you for your participation. Tomorrow there is 2 more sessions. There's a CP seminar in Ashoka Hotel. Please do register if you have not yet registered. Thank you.